how does someone between their 20s and 30s try and find the right mix between risk and safety?
Absolutely, a very good question. See, youngsters now, they have to focus on setting a vision. Investment with a purpose, sustainable opportunities are there. Waste to values, solar, wind, biofuel, biomass, a portion.
So how can young investors get to that point where they can adapt like that?
If you don't know the weather, you can't sow seeds, right? So your harvest is what your focus is all about. With the seasonal changes, you have to put different crops.
Why is patience actually underrated?
People think they want to hit and run with the money. It doesn't work like this. Now, if you want to make big money, you take measurable risk.
Hello everyone, welcome back to the Green Generation podcast, where we talk about sustainability, business, and everything in between. And I am Shruti Seetharaman, a content creator and entrepreneur, but also someone who's super curious about how we can make better, smarter decisions for the world that we live in. So today's topic that we're talking about sounds deeply technical, but I think is extremely human, and we're talking about asset allocation. So joining me today, I have Dr. Seetharaman, who is a global banking visionary known for championing conscious capitalism. Welcome to the podcast.
Thank you. Thank you for having me.
Okay, I'm gonna want to decode everything about asset allocation, balancing money, all of that. But I'm gonna start with the very basics, right? So very simply, can you tell us what exactly is asset allocation and why should young investors care about it?
Absolutely, it's a valid question. Balancing your life, balancing your growth, balancing your investments are all same. You cannot have lopsided outcome. A good life is a balanced life. Good investment management is balancing the portfolios. So it's all striking with one word, balance. What does it mean? Like, you can be a professional. You can't just keep on working hard without balancing your life. You have all stakeholders, like your family members, your corporate life, your social responsibilities. So, when you manage an investment, you can put it in stocks, high growth. You can put it in permanent fixtures like housing. You can have fixed income in the form of bonds. You can have your security risk management in the form of insurance. So you can also have immediate purpose, emergency reason, liquidity in the form of deposits or cash or gold. You can also have a fast track opportunity in terms of commodities, buy and sell. So it depends on your vision, it depends on your age, it depends on the allocation you make. That's what is important. A balanced allocation based on your capacity, based on your age factor is what we call it as asset allocation.
Okay, talking about, obviously with asset allocation comes risk, but I also want to bring up a case which is the family office case, who are known as the legacy protectors, right? Who believed in harmony over returns. What do you have to say about this case and anything related to all of us who can understand it better and try and incorporate that into asset allocation?
Everything is for family welfare. Everything is for harmony. Whatever you invest, you need a good legacy. You care for your children. The outcome should be for intergenerational, again, in long term. That's why when you say family office, it's a must. Whether small or big, size doesn't matter. The opportunity is to make sure you leave something to manage life in case of contingencies for your family. That's what matters. So a good investment manager will always recommend, do you have the legacy to continue? Do you have a will or do you have a trust? What happens after you? It's very important. So family office management, you have your own lawyers, you have your own accountant, you have your own will and trust. These are important imperatives for you to carry a long-term vision and pass it on to the next generation.
And we do also have a separate episode on the family office, allocation, investments, all of that, which we have already aired. But I'm going to move from one case to another. I want to talk about how Yale University famously changed the way endowments are invested, and they dare to be different.
Absolutely.
Yeah, what can young investors learn from this?
It's a good case study. The Yale consists of younger minds. Purpose of creating such experimentation is to make sure we create entrepreneurship in the younger minds. It is easy to invest in known stocks. It's easy to invest on safe assets. What is more important, Yale has tried, experimented, is to have safety and security at the same time. Innovation plays a big role. They experimented with young entrepreneurs who have innovation in their forefront. They put a seed capital. Graduates focusing on innovation. If you give a seed capital, because you trust them and allocate a portion of Yale's corpus, and they manage to innovate, be creative, and then take it to public. Once your intellectual property is visible, then sky's the limit for you to perform. And that's what exactly the trigger is all about. Yale has done very well.
Talking about young investors, and I think something that I'm also curious to understand is how does someone between their 20s and 30s try and find the right mix between risk and safety?
Absolutely, it's a very good question. See, youngsters now, they have to focus on setting a vision. Investment with a purpose, sustainable opportunities are there. Waste to values, solar, wind, biofuel, biomass, a portion. Because profit with purpose, investment with purpose. Set a long-term vision, have a balanced growth. Asset allocation becomes easier. Short-term, quick money you want, you can experiment on market-specific equities or even commodities, gold, even digital tokens, cryptos. I'm not recommending cryptos, it's speculative tools. You can make money or you can lose. You can also have fixed income, stable returns for you. So the vision is long-term. Make sure you monitor time and again. Your asset allocation should be scientific.
Okay, and sounds almost like you're saying balance your head and heart.
Yeah.
Sort of like the University Endowment Case. That
Yes, that's a brilliant case. See, when you invest, it cannot be emotional alone. Investment is emotional because everyone is aspiring for very good return, maximum return. Yeah. It doesn't come easily. So you have to apply yourself in terms of the information, data analytics, which asset class you invest, what's the trend, how do you see the opportunities, underlying economic fundamentals. These are very important.
Yeah.
So head has to play a big role. Add to that, your heart has to converge. So it's a combination of both. So you make a meaningful decision.
Absolutely.
Your emotion also plays a role. Your gut plays a big role in recognizing this opportunity, and you should feel good when you invest.
Balancing the head and heart is always the everyday task, right? But I'm also going to move on to another case, which is the weather watchers.
Yeah.
They change strategy based on market seasons, right?
Absolutely.
So how can young investors get to that point where they can adapt like that?
If you don't know the weather, you can't sow seeds, right? So your harvest is what your focus is all about. With the seasonal changes, you have to put different crops, right? What is possible in one part of the land is not possible in another. So underlying economic fundamentals are important. The weather in economic terms is to recognize the seasons and also economic fundamentals, and ensure you focus on fine-tuning your outlay based on market specifics.
Yeah.
So you have to necessarily make sure which market I should put. Sovereign funds, for example, they go through multiple sectors they invest. One country could be real estate, one country could be agriculture, one country could be on the semiconductors. So it depends on how do you allocate, which market, why.
Okay. And I feel like I want to ask, can emotions like greed or fear really move markets?
Absolutely. Now look at what's happening in gold. As we speak, it is over $4,000 per ounce. Why? World over, people have invested in currencies and commodities. They have shifted because currencies are weakening. They hedge the risk by buying commodities. Gold is as good as currency. They substitute, including the regulators, central bankers around the world, the reserves, they are putting it in gold. So that is the reason why it is peaking. Emotions plays a role. Credit Suisse is a classic example. When social media exaggerated, FINMA, the regulators, have taken a decision to combine UBS with Credit Suisse. It's a fear. Because they don't want contagion risk in the market. It has become a systemic risk according to them. So Credit Suisse collapsed. It was bought out by UBS. The transaction is right or wrong. In my opinion, there are a lot of unlawful actions, like writing off nearly $20 billion of pension funds money or additional tier 1 bonds, COCO bonds we say. So that is a mistake. But at the same time, the fear has triggered this. So sometimes people overdo or underdo based on market fears. You have to balance. Fear is to be substituted with facts and then make sure you take a right decision with a balanced mix, ensuring all the stakeholders you have to bear in mind.
And I want to move to something that you've always told me as I'm trying to understand asset allocation in general is in terms of patience. So speaking of patience, the weekend investor case. I know I'm bringing up a lot of case studies, but I feel like these are super interesting to get audiences to understand sort of what we're talking about and why. But yeah, the weekend investor case showed how boring consistency can actually be freedom. So why is patience actually underrated?
People think they want to hit and run with the money. It doesn't work like this. Now, if you want to make big money, you take measurable risk. You look at a project specific, you look at the innovation model, you look at the intellectual property and bet for long term. I put it as a private equity.
Yeah.
Before it gets listed, you invest because it's a good idea, it's a good investment, a good sector, good model, business model. It'll have long-term opportunity. Like technology today, AI companies, runs in billions.
Absolutely.
Right?
Yeah.
So some companies even touch trillions. So the reason why we admire is because it has got exponential opportunity, but it is a private investment to start with. Absolutely, strategic patience. You have to wait for, medium term or long term even. That helps you to consolidate. So it depends on the mix. You cannot rush and make money out of it. Patience is smooth is fast.
Slow and steady wins the race.
Yes, absolutely.
But you also did talk about AI, and AI now also manages portfolios, right?
Yep.
Like, for example, another case that I bring up is the student that never sleeps. So the question again is, in terms of asset allocation, can technology really replace human instinct?
Absolutely not. You need technology. You need the data science. You need data analytics. You need to interpret these informations and make a judicial decision, wise decision. Now, when you do that, you have to apply your own emotions, feel-good factor. Unless you are convinced, just because someone is advocating, it should not jump.
Head and heart.
You have to, yes, simple. You converge on head as well as heart. That's the logic, I should say. Technology is important. Technology is a great enabler, It can suggest you, but you think it over to see whether all the facts and figures are, put through for technology to give their analysis, and then you make your decision. You stand by what you did.
Very interesting. I think this is quite encompassing of all of the first few questions I would want to ask. So hopefully that's answering most of your questions. If you do have more questions, of course, shoot them down below. But before we wrap up, I want to ask you is that if a young investor is making their first investment, what's the one advice you'd want to finish this episode with?
Have a balanced mix. Define your goal. Make sure you have a long-term focus. At the same time, split the asset, diversify the risk, and make sure that you are cautious. At the same time, you are prudent, and apply the data science to understand the dynamics of what the opportunity is all about.
I mean, I think, like I said, I think this was quite encompassing. But of course, if you do have questions, like I said, please shoot them in the comments below. I think we've covered everything, including head, heart, patience, AI, and the basis of what asset allocation is. I think it's super important for every one of us to understand how we should be investing our money, especially young entrepreneurs, young investors that want to be able to create. And I think now is the time where all of us want to sort of create our own life and work for ourselves. So hopefully you enjoyed watching this episode. Thank you so much for giving us some insight. And don't forget to keep watching. We will see you in the next one.